Chris, it's great to have you on the show. I can't figure out if it's a good environment for the banks because you want to see higher yields, higher interest rates. It helps the margins. But we're also seeing this deeply inverted yield curve. So I can't figure out what kind of environment that is for you.
Yeah. Well, Sarah, first of all, thanks for having me. I think in general, where all the banks are focused, and frankly, where the economy is focused, is what is the impact of these higher rates? And I'm frankly not surprised that the rates are higher. I think the Fed's been pretty clear from the very beginning that price stability and controlling inflation was at the top of their list. And I think for a while, the markets thought, that the rates would go up to, Fed rates would go up to 340, 350, and then start coming down in 2023. And I think Chairman Powell was pretty clear last Friday that, the Fed is going to continue to do what they need to do to control inflation. And then the question is, what does that mean for credit quality? And I think that's what many of the bank investors are focused on.
So what does it ultimately mean for credit quality and for your business?
I'll tell you, we think we're really well positioned. We've been de-risking over the last decade. As we look at the health of both our consumer and our commercial clients, I'll give you an interesting statistic. Our consumers today in non-interest-bearing accounts have 60% more cash in their accounts than they did going into the pandemic. So we feel like our customers are well positioned for what will be probably an inevitable downturn, and they'll be able to weather it.
60% more cash deposits than pre-pandemic. That still holds today, even though we've started to see savings being drawn down.
Exactly. And so that is one of the things that gives us confidence of the resilience, not only of our customers, but of the customers throughout the country. And on the commercial side, Sarah, the real challenge there is not so much inflation, is not so much their business slowing down yet. It's the scarcity of labor. And that's really where our commercial customers are focused.
So you painted a pretty optimistic portrait a few months ago in earnings about loan growth, both commercial and consumer. Is that holding up?
It is. We continue to see loan growth on a linked quarter basis and year over year. And part of that is as the supply chains, Sarah, become a little less, free up a little bit. People are able to, one, get inventory. And secondly, in an environment where there's a lot of inflation, people are more likely to sort of go long on inventory than they have in the past, particularly given some of the challenges people have dealt with in terms of availability.
So from your vantage point, it sounds like, Chris, you think the economy looks pretty okay. Are you expecting recession?
I do. I think, look, it's inevitable that the economy is going to slow down. We're slowing down as we speak. And then the question is, how deep, how long? And I think that really remains to be seen. We're kind of in uncharted territory. You have, coming out of the pandemic, you have very significant rate increases. And one thing that a lot of people aren't talking about is concurrently, the Federal Reserve has to unwind this $9 trillion balance sheet. So I am optimistic. I do think a soft landing can be engineered, but it's complicated and it'll be tricky.